Okay, so if we have to look not on an index level, but sort of parse through a little bit, is it as simple as like you want to buy a little small cap, buy a little tech, like that's your barbell right now?
You know, Alex, I think it's tricky. And just to disclose, I have a very boring portfolio. I've been super focused on dividend yield, just super focused on making the most of really great returns to cash. Tech, I think, is a curious one. I think it remains overvalued for the most part. But I think there are some pockets in there, particularly on the B2B side, where you're seeing much better execution than we've seen for the last 2 to 3 years, and margin uplift as a result. That's pre-AI hype. We're starting to see management teams really focus. And we're really starting to see, I think, the winners beginning to benefit from businesses wanting to consolidate their spending with some of the biggest players. I think that's where I'd look to play growth. Small cap's a little bit different. I'm looking at some equipment players that are taking a different approach.
And so you're not feeling FOMO at this point? You're not feeling that desire to chase some of these incredible returns that are being generated by AI?
I'm not feeling FOMO. And actually, the great benefit of having been trained on the private side is you can't actually feel FOMO because you can't trade in and out of your positions. You have to have conviction for the longer term. And what I think is really interesting about the AI narrative, I think there is consensus that to see the real benefits of AI, you've got to be in it for the long haul. So much is unknown right now. And so I think having the perspective of taking a step back and saying, OK, where are the secular tailwinds? It is going to be where you've got real uses of generative AI. It is going to be on the industrial side where you're going to see real integration of data so that you've got, for example, demand planning tying to how you manage your inventory in a much more integrated fashion. But to take that perspective, you've got to be willing to ride out capital replacement cycles. You've got to be willing to look at proof of concept on the software side. You've got to take the longer term view, and you can't have FOMO to do that.
Right, so it's going to be an investment thesis, not a trading thesis for AI at the end of the day. You mentioned small caps equipment makers?
Yeah, well, less on the small cap side
just in general,
but in general.
Like that's where you're taking on the quote-unquote risk.
Yeah, I think there's some equipment, which, by the way, it's going to be a bumpy ride, because even though the view is there's going to be a soft landing, there is still a very high likelihood there'll be some kind of recessional correction. I'll give you an example, Alex. A story recently that was interesting was Deere & Co. That really captured the imagination, where you can get an equipment manufacturer that really owns farming and agriculture, now really penetrating using data and smart agronomy to build share. Let's take that, for example, into medical devices. So I'm starting to look at places like Medtronic, which has had execution issues, but you can't argue with the fact that they're a winner out there in terms of medical imagery that will benefit from AI over time, and you're going to have to see hospitals and clinics and medical providers really buy into a new capex cycle over the longer term.
And fundamentals matter, but when you're getting big macro moves like we're seeing at the moment, and this is a top-down, liquidity-driven market, how much do those fundamentals really matter on an individual stock-by-stock basis?
I think it depends on the sector, guys. So, for example, when you're looking at liquidity constraints, and obviously you've got to look at things that are heavily tied to consumer spending, as I said, like auto, you've got to look at the financials, you've got to look at banks, where you're going to see contraction in terms of what they're able to actually execute on for both corporate and consumer borrowers. I think on a stock-by-stock basis, looking for those individual names that are less exposed to a potential credit crunch becomes very important. So, for example, to pick, Walmart is one that I've been piling into that's worked out very well so far, or where the ticket is small enough that's less exposed to borrowing risk. That's important. But again, if we want to invest rather than trade, you're going to have to look past what the near-term restraints are going to be.
You called yourself boring. What would make yourself not be boring in your portfolio?
Oh, well, some of the things that have been a little bit more glamorous, Alex, have been Spotify. I'll give you an example there. It's still tied to this thesis of, I think, the big get bigger. If you want to find one name that's all about how, in this case, the consumer is consuming music, Spotify is the name that you go to. That's a little bit less boring. One of the other ones out there that I think is starting to get a little bit more interesting is Amazon. I've talked about Amazon tons in the past, but if you look at what they're doing with Prime Video, what you're looking at on the content side, I don't think they have mined their full potential quite yet.